This is Tom Kozlik, Head of Public Policy and Municipal Strategy at Hilltop Securities. Thank you for joining us for this 2026 episode of the Hilltop Talks Politics and Finance podcast. On this program, we speak with subject matter experts about the issues where politics and finance meet across federal, state, and local levels in the United States. We often focus on public finance and the municipal bond market. Energy continues to be an important topic in 2026, and today we're lucky to have a guest to help us understand energy prepay bonds and why the use or issuance of them has increased so much recently. Pat Luby from CreditSights is here with us. Pat is the head of municipals and a senior municipal strategist at CreditSights, and he also leads CreditSights' work on fixed income ETFs. He is one of the most widely respected and recognized voices in the municipal market, an acknowledged expert by many, including me, especially on municipal bond ETFs. His insights on market trends and relative value especially are highly regarded by institutional investors, asset managers, wealth advisors, broker-dealers, ETF sponsors, and non-U.S. investors as well. He has spoken at numerous events and has been quoted in the Bond Buyer, Bloomberg, the Wall Street Journal, Barron's, the Financial Times. Recently, he was on a panel at the NFMA in Atlanta. Pat has experience in the sector from several different seats, different viewpoints, which makes his perspective very valuable, I think. I think his unique breadth of understanding really draws on that experience in the trading, research, and sales areas of the municipal sector. And finally, Pat's been with CreditSights for 9 years. Prior to that, he was at Charles Schwab and UBS. Thank you very much for joining us today, Pat.
Tom, I'm excited to be here. Great to be with you today. And this is a really interesting topic. We've gotten a lot of questions ourselves, and I think we'll be able to have a helpful conversation.
Awesome. Great. Looking forward to it. I'm going to start it off, Pat, with which I think is, sometimes the easier questions are the harder questions. And, from my perspective, energy prepays, gas prepays, what are these called? How should we be thinking about them? And what are they?
You're right. It's a simple question, but the answer is a little bit longer. But it's not that hard for anyone in munis to understand. Energy prepays are bonds that are issued in order to raise funds in order to lock in a discounted future flow of energy to a utility. So just like anybody who would want to negotiate for a discount, somebody who's providing that future service, in this case energy, they'd want to know that if they agree to a discount, that the buyer is going to be able to pay for the future delivery of whatever that is, in this case, gas or electricity. So the bonds are issued in order to raise sufficient funds to be available to pay for future deliveries of energy as they are delivered. Now, it's important to note that the energy is paid as it's delivered. The entire lump sum is not delivered to the energy supplier to deliver out. So the supplier gets paid as it's delivered, whether it's gas or electric. And the advantage is that the utility and ultimately the customers of the utility are able to get access to energy at a discount to the prevailing spot rate. Perhaps one misconception is if bonds are sold today, the price for the future energy is not locked in at a fixed rate. The energy is locked in at a fixed discount to the then future prevailing market rate.
Okay. So give us an idea of a combination of the flow of funds, the structure. How does that work?
Well, it's difficult to be precise because there are variations from issuer to issuer and even series of bonds to series of bonds. So there's a handful of issuers in the market, and they have issued in some cases on behalf of multiple different ultimate utilities. So broadly speaking, the bonds are sold investors pay for the bonds. The money then goes to some sort of holder who's going to hold that money for payment as the energy is used. Now, a part of the transaction will be the participating utilities, and so they're a party to the transaction. They will be contractually obligating themselves to take some amount of gas or electricity at a particular schedule into the future. And as they draw down the the energy, as they draw on that energy, then whoever is holding the bond proceeds will actually pay for that. There will be swap contracts involved so that the energy supplier and the holder of the funds is not subject to extreme gyrations in the markets. But that's not as material to the bondholders, the investors in the bonds, as who's holding that money. The rating agencies, when they look at rating these bonds, they look at who's the weakest link in the parties to these transactions, and it's typically the financial counterparty that is ultimately holding the bonds. That counterparty can be referred to by a couple of different names in the documents. Typically funding recipient is how we refer to that party in the reports that we've written, but they may have slightly differing terminology depending upon who it is. But the practical effect is they are the funding recipient. They're receiving the money and they're paying it out. From a credit worthiness concern, bondholders are worried about, well, what's the credit worthiness of this entity that is receiving the funds? Because it's if there's a problem with that funding recipient, the obligation to return those funds is a general unsecured obligation of that entity. So the energy prepay municipal bonds generally carry the rating of the lowest rated entity involved in the transaction, and it's typically the funding recipient. So that depicts too that this is clearly not like a traditional tax-exempt municipal financing where you might have a municipal utility issuing bonds for whatever purposes, capital improvement plan or whatever, and that utility is going to generally have a minimum debt service coverage ratio or a covenant to maintain rates to maintain a debt service coverage ratio. The obligation of the utilities on the prepay transactions is not open-ended. They are agreeing to take delivery of gas. They are not directly obligated to make debt service payments on the bonds. They are only agreeing to take delivery and make sure that the payment is provided for on those that utility.
So how are the bonds typically structured or issued for, are they taxable, tax exempt? Are there serials terms? Are there other special structures that are used? How does that look?
Well, the structure has definitely evolved over the last couple of years. These transactions are typically, honestly, long-term transactions, so 20 to 30-year agreements. But because the financial parties are generally not going to want to obligate themselves over a 30-year span, whether it's for swap contracts or energy delivery or whatever, that's just too much uncertainty for these parties to want to commit to. So typically they will agree to a commitment of 7 to 8 years or so, plus or minus a little bit. So previously, a lot of the energy prepay bonds were structured with a mandatory put feature that coincided with the date when those agreements would get reset. And so from a portfolio manager's perspective, that's kind of messy, right? You have a 30-year bond, but you have a mandatory put. How does it get reported, through my pricing vendor? If I'm an SMA manager, how does that show up on client statements? Is the client going to ask me about this mandatory put? So based on feedback from the buy side, the bond structuring has evolved. So now they are typically priced as having a 7, 8, maybe 10-year final maturity date. But those bonds will get remarketed, typically will get remarketed after that date occurs, since the contracts underlying the transactions are longer term. So all of the terms would be subject to getting reset when they get remarketed at that point in the future. But from a pricing perspective, where they get priced, where they get spread, they're now, because they're now typically getting priced with a fixed maturity redemption date. That's how they're getting priced.
And are they taxable or tax exempt typically?
Tax exempt.
Okay. And then what happens at the mandatory tender date?
So on that mandatory tender date, I'm not sure if there's any that are still outstanding that have a mandatory tender. There probably are, but the bondholders would are required to tender their bonds and get par back, and then the bonds would be remarketed. Obviously, that creates some uncertainty. Well, who's going to pay for the redemption of those bonds? Well, hopefully, it's going to be from the proceeds of the remarketed bonds would pay for the principal that has been tendered. So that does create some uncertainty. What if the underwriter cannot successfully remarket those bonds if, for whatever reason, whether the financial counterparties don't want to renew, or it's a lower rated counterparty that steps in, or the markets have shifted and it's not as easy. So in that case, the structures are generally set up so that if there's a failed remarketing, there will be resources available within the financing to be able to redeem the bonds and to pay the bondholders at par.
So, like you alluded to earlier, these are not like traditional municipal bonds. What are some of the specific bond covenants that municipal analysts should be really focusing in on these? And you mentioned this also, that there are differences on kind of deal to deal, the deals have evolved. What are the bond covenants that analysts should be really focusing in on right now in these transactions?
Really important question. I think for analysts, when you're going through a due diligence checklist, these bonds need to have their own checklist. A couple of things to look at very carefully is, what are the tender and the purchase obligations? So the mechanics of the tender and the purchase um, can vary from deal to deal, and again can vary from series of bonds from one to the next, based, even the same issuer may have slightly different mechanics. So they look similar, but they are not necessarily cookie cutter deals. So look at specifically the tender and the purchase obligations. Also will be spelled out are the termination events, and what kind of payments and where payments are going to be coming from on each transaction. There are subsections to that also. What constitutes a termination payment will be defined in the indenture. What constitutes supplier bankruptcy? What happens? What if there's a downgrade of the guarantor? What happens? What if there's a hedging failure, remarketing failure of the bonds? There's a variety of different events that have to be paid attention to that could trigger a termination of the transaction or lead to a payout on the bonds. So again, each of those events is a component of the counterparty risk that's associated with each of these transactions. So even though it's tax exempt, because you've got these extraordinary events embedded in the risk, it is definitely different from traditional public finance.
Are they typically?
Oh, I was going to say the other covenant that is really, really important, but it's very low risk. So personally, I'm generally not terribly concerned about the credit risk on these. Obviously, it's more of a corporate credit risk than a municipal credit risk, because you have for-profit entities that are holding the funds, and so it's definitely a corporate credit risk. So, but I do think that the credit risk on most of these transactions does not keep me awake at night. What I am concerned about is the tax covenants, because these are complicated instruments. They are issued as tax exempt municipals. The key here is what's referred to as the qualified participants. What does that mean? So the qualified participants in these transactions are the not-for-profit municipal utilities that are engaged in the transaction. So if you have a traditional municipally owned utility that is seeking to lock in a discount for the future deliveries of energy, they are a qualified participant. Every municipal utility is going to have some percentage of their usage is going to go to businesses, industrial users, right? There's no such thing, I suppose there is possible, but at least in munis, it's unlikely that we're going to run across a municipal utility that is 100% residential. So all of the traditional municipal utilities, which are treated as qualified participants in these transactions, some amount of their energy distribution is going to be to industrial and business customers. Um, where I think there's potential concern is in the case of a transaction where the ultimate consumer of the utility is a large industrial user. If for some reason in the future they no longer need that energy, then the energy would have to get remarketed to some other user, and it to maintain the tax exempt status of the bonds, the energy has to get remarketed to another qualified participant. In some deals, my reading of the documents was that if they couldn't be remarketed to a qualified participant, the bonds would potentially be collapsed and paid off. But some of the other deals that I've seen, the language suggests to me that if they can't remarket the energy that has been contracted for to a qualified, ultimate customer, maybe it goes to a non-qualified customer outside of a traditional municipal utility. That could potentially put the tax exemption of the bonds at risk if that happens. Is that a huge risk? No, I don't think so. It is a non-zero risk that I think it's important to understand.
Okay. Are these transactions typically rated?
Yes. I don't know that I've seen any that have been non-investment grade.
Okay.
Um, there are a handful of triple B, but as of the end of May, out of the prepay universe, so this is indexed bonds, so bonds in the ICE Muni index,
Mm-hmm.
105 billion of prepay bonds in the index. 34 billion are double A, 64 billion are single A, 6.6 billion are triple B.
Okay.
And I will
Eh,
say, while I'm on this page too,
yeah.
the prepays in May outperformed the index overall. The prepays as a group earned a composite total return of 0.59% versus 0.43% for the index.
Well, that actually is a good segue into the next question I was going to ask. I was going to kind of transition to some investment questions, and I was going to ask kind of from a portfolio management perspective, how do you think that these fit into a portfolio?
So a couple of important points I think to make here. Um, the sector has grown in issuance, right? So in 2016, issuance of prepays was 1.1 billion, 0% of the new issue market. 100% of those bonds in 16 were gas prepays. If you skip ahead to 2025, 31 billion of issuance, so it was 5% of new issue volume. And issuance was split between gas, electric, and combined. 45% were gas, 23 electric, and 32% were combined. So far this year, we've got through the end of May, almost 15 billion of issuance, which put it at 6% of new issue volume. Two-thirds gas, one-third electric, and a small amount of combined. Now, the gas bonds typically, when they are assigned to an index, in the ICE indices, for example, they're assigned to the revenue utilities other. The pure power bonds go into the power bond utilities index. Um, I think it makes sense to group these together as a separate category. And so when you're thinking about, okay, so what's an appropriate portfolio allocation? Because I think you're looking at a corporate credit risk here, right? It's not an essential service revenue bond as we normally would think of it. So what's an appropriate weight within a portfolio? I think it's appropriate to look at what's the combined weight of the power and the utilities in the index that you're benchmarked to. And so I think your allocation of energy prepays should be a portion of those two combined sectors in your benchmark and in your portfolios. And then when you're looking at specific positions in the portfolios, because the credit risk on these is tied to the funding recipient, and that's going to be the source of the rating, it's important to keep track of who are the corporate counterparties that you're adding exposure to in your portfolio, and make sure that that is diversified either across accounts or within your portfolio.
And the last thing that I wanted to ask Pat was how are these performing and what benchmark is it that you compare them to when you're doing that analysis?
So they're honestly performing pretty well. Uh, the double A. Well, if you look at prepay power bonds only, so just electric prepays, comparing those to the power bond index. Again, this is just for May, but the power prepays earned a composite return of 0.66 versus 0.53 for the traditional power bonds. Again, we're talking about a different credit risk, so there should be incremental spread on these. They are attractively priced and spread versus traditional municipals, and I think you see this here. If you look at the power and utilities combined, the prepay power and utilities combined earned 0.59 in May versus 0.55 for the combined indices together. So if you're looking at the new issue deals, yes, they are attractively spread to the broader market, but it's not an enormous amount of incremental spread. You don't have a lot of duration on these bonds either, right? So it's typically 7-8 year final maturity. But it does offer incremental spread, incremental yields in that part of the curve. It's a part of the curve that is super crowded, very difficult to get new issue money to put to work in that part of the market. So I think that's partly why we've seen the underwriters and the issuers adjust the serial and term structure to be more appealing to SMA managers, so it's easier to put these into a portfolio.
So before I close, Pat, I want to do a little marketing for you. I want to mention the reports that you've put out about, well, not only I'm kind of putting this into two buckets, a combination of the reports that you put out specifically about these types of bonds, but then also the market commentary. That's it's something that I found very, very useful, and I just want to make sure that the folks who are listening know that is out there, and that it's. I mean, these are relatively newer, relatively changing. Whether it's folks on the analyst side or on the investor side from a bigger picture, the reports that I've read that you've done on this topic, on this theme, are have been very, very helpful, right? And so I want to make sure that folks out there know that those exist. I'm not sure if there's anything else to say about those, Pat. If there is, especially based on, I mean, the things that I've read recently. I'm not sure if there's anything that you've done recently. And I'd have to imagine that at some point we'll have to have you back. We'll talk more about what's been happening in the market related to these, right? I mean,
Yep.
because as you're noting, things are changing.
They are changing. I appreciate the kind words too, Tom. I will say, I've been at CreditSights for 9 years, and gosh, I love it. We are a subscriber paid research firm. We're not in the business of what our clients are in the business of, which is underwriting or managing securities. So that gives me great latitude to write about things that our clients find important. So our clients range from broker dealers to asset managers, asset owners, SMA managers, mutual fund, ETF managers, non-U.S. investors, you name it. We have subscribers in that space. So folks who are listening, in some cases, your firms might actually already be paying and have access to CreditSights. So feel free to ask around. Of course, you can reach me anytime. I'm on Bloomberg. You can find me on LinkedIn, and love hearing from anybody in Muniland.
Thanks very much, Pat. Thanks for today. I really appreciate it.
You bet. Great to talk with you, Tom. Thanks to everyone for listening.
And I want to thank everybody who tuned in and downloaded the podcast today. We appreciate you listening. I'm going to thank Pat again for joining me. I really enjoyed this discussion. And for those interested, you can also see the recent Hilltop Securities economic and municipal commentary and listen to our podcast by going to hilltopsecurities.com/commentary. You can follow me on X and LinkedIn. The podcasts are also on Spotify and iTunes. I'm going to thank everyone again. We look forward to bringing you more color in the future related to the topics that intersect the world of politics, finance, and public finance. This has been Tom Kozlik from Hilltop Securities.